Hey everybody, Raul Shah, Doc Shah Financial, and in today's video, I'm going to give you the complete guide to understanding your RSUs. RSUs tend to trip up a lot of people, but honestly, they're very easy, and I hope at the end of this video, you'll realize that if I do my job right. Restricted stock units are shares of a company that are given to you if you meet a certain amount of time spent with the company, or if you meet certain performance-based measures with that company. There's really two important dates that you have to keep in mind: the grant date and the vesting date. So the grant date is the day that the company actually awards you the shares. Now, this is a little confusing because even though they award you the shares, they haven't actually given them to you yet. They have basically just said, hey, this is what we are going to give to you if you meet certain criteria. The grant date is not important unless you're filing Election 83B, which we'll get to in a second, but don't worry about the grant date so much. It's the vesting date that really matters. And the vesting date is the day that the shares actually become yours and they go into your possession. Now, there's two types of vesting schedules that RSUs follow. You can have a graded vesting schedule or a cliff vesting schedule. And they are pretty intuitive, so you might kind of see where I'm going with this, but let's just use an example. Let's say that a company awards you 4,000 RSUs, and let's say that it vests 25% for every single year until all 4,000 RSUs are given to you. Well, that would be a graded vesting schedule, because at the end of year one, you're given 1,000 RSUs. At the end of year two, you're given the next batch, year three, the next batch, year four, the next batch, and ultimately you will get all 4,000 RSUs, 1,000 each year. In a cliff vesting schedule, you are not given any shares in year one, year two, year three, and then in year four, you get all the shares, all 4,000. Again, it doesn't have to be 4,000. By the way, I'm just using that in this example, but that is in general how the two vesting schedules work. You've got the graded like this, and then you've got the cliff, which is flat, and then boom, just straight up like that, if you want to, conceptualize it. All right, now for the $1 million question: how am I so photogenic? Oh, no, that's not it. How are RSUs taxed? So there are two times where your RSUs are going to be taxed. The first time is going to be when your RSUs vest. So when they come into your possession, right at that moment, that's when you are going to have created a tax liability for yourself for that year. And the second time is if you sell your RSUs in the open market, just in a stock market, and you wind up with a capital gain. So let's go through an example to help you understand how your RSUs will be taxed. Again, we use the first example. If a company awards you 4,000 RSUs, 1,000 each year for 4 years on a graded vesting schedule, then at the end of year one, 1,000 RSUs will have vested. Let's say that the stock price at the time is $10 per share. That means that you got 1,000 shares at $10 a share, so you just got a $10,000 value of RSUs. Now, the IRS doesn't look at RSUs as something special. They basically just treat it like your salary, so they're going to tax it like your salary. You're going to get taxed at ordinary income tax rates. So let's go back to that example. You just got a $10,000 cash bonus in the eyes of the IRS. So if you're in the 32% federal income tax bracket, that means that you'll owe $3,200 in tax for your $10,000 RSU bonus. So if you're in the 32% tax bracket, you'll owe $3,200 on your $10,000 bonus. Now, the company actually withholds 22% of your RSUs to cover that tax liability. Now, typically they undercover, they don't withhold enough, and so you'll have to actually make up the difference. So if the company withholds 22% of your RSUs, that means that out of those 1,000 RSUs that they were supposed to give you, they're actually only going to give you 780. And they're going to take the 22% or the 220 shares, liquidate that themselves, send that to the IRS. So they just sent the IRS $2,200 to cover what they expect the tax to be. Now remember, you're in the 32% tax bracket in this example, so you still owe 10%, which means that you've got to cover that tax liability when it's time to pay your taxes ultimately. So how do you do that? You've got three different ways you can do it. You can sell to cover, which means you have 780 RSUs left. The stock's at $10. You need $1,000 to cover your tax liability, so you sell 100 shares. You'll be left with 680 shares in your company stock. You take that 1,000 and you can ultimately send it to the IRS. Another option is you could sell all your RSUs. So you were given 780 RSUs or shares. You could just liquidate them all. You'd be left with $7,800, and then you could take $1,000 out of that, send it to the IRS, and you're left with $6,800. Or you could just leave your RSUs as is. You could keep all 780 RSUs don't have to touch it, and you can take $1,000 from somewhere else. Maybe you've got it laying under your mattress, maybe you've got it in your bank, and you take that and you send it to the IRS. So those are your three options on how to actually pay your income tax on your RSUs. Now, the other time your RSUs are taxed are when you incur a capital gains. So if you keep those shares, once those RSUs vest, they're just shares in the company, like, if you just bought shares on the stock market, same thing. And if those shares rise in price, you now actually have a unrealized capital gain. And if you sell the stock at a profit, you'll pay capital gains tax. If you've held the stock for less than 1 year, you'll just pay your ordinary income tax rate on that profit. And if you held it for longer than 1 year, you'll pay the long-term capital gains tax, which is anywhere from 0 to 20%. So those are the two times you'll incur tax on your RSUs, when they vest and if there's a capital gain. Remember when I mentioned Election 83B? That's a special provision where you can actually elect to pay your income tax at the time the stock is granted to you instead of when the stock actually vests. Why would you do this? Well, if you think that your company stock is going to go ballistic, well, then you would rather pay tax at the grant date when the price is lower than at the vesting date when you expect it to be much higher. The biggest risk that you take with RSUs is you are paying tax when that stock vests. If, for example, the stock price then precipitously falls, then ultimately, if you have to then liquidate shares to pay that tax, you may not have enough shares to actually cover your tax liability. Because remember, the tax is incurred when those shares vest. And if they vest at a really high price, and by the time you sell it, it's at a really low price, well, then you've pretty much squandered not only your bonus, but you've also now got to make up that tax liability. So that becomes very risky. Generally speaking, you want to treat your RSUs like a cash bonus. If you were going to receive $10,000 in cash from your company, would you go and buy your company stock? If the answer is yes, then it makes sense to just keep your RSUs. If the answer is no, well, then maybe it makes sense to sell your RSUs and diversify into something else, or just go on a vacation, or really do whatever you want with that money. A couple interesting notes: there are double trigger RSUs. Those are typically in private companies. The idea is that you need 2 triggers for these RSUs because otherwise it wouldn't even really make sense. In a private company, you can't just go liquidate the shares to pay the tax, so it wouldn't really be fair to you if you were incurring a tax at the time that your RSUs vest, but then you can't sell the RSUs to anybody because it's a privately held company, but you owe the tax, so what do you do? So because that's not really fair, they've come up with this double trigger RSUs where you don't actually have to pay any tax until A, the shares vest, that's the first trigger, and B, there's a liquidity event. So maybe the company changes ownership, or there's a tender offer, acquisition, IPO, somewhere where you can sell the shares. That's when you'll actually owe the tax in a double trigger RSU. So it won't be at the time that it vests, it'll just be at the time that the first trigger and then the second trigger, which is the liquidity event, go off. All right, guys, thank you so much for watching. I really appreciate it, and I hope you learned something. If this was overwhelming, or you're looking for help with financial planning or investment management, just shoot me an email, Raul@dogshotfinancial.com. I'd love to hear from you, and thank you so much for watching.